dive into the world of investment funds as we compare SCHG and QQQM, two giants in the realm of growth fund investing. SCHG and QQQM are renowned for their robust growth trajectories, making them pivotal players in many investment portfolios. To ensure an accurate comparison, we'll use QQQ data as a stand-in for QQQM thanks to their equivalent performance metrics. So I'll refer to QQQ as QQQM. We're setting the stage for a riveting showdown based on initial investments, imbalances, and a slew of other financial indicators. Stay tuned as we break down the numbers to see which fund might suit your investment profile. Imagine starting with an investment of $10,000 in either SCHG or QQQM. Let's see how they fared over time. Both SCHG and QQQM began their financial journeys with the same initial stake of $10,000, setting the stage for a direct and equitable comparison of their performance. As time marched on, the outcomes for each fund began to diverge significantly, reflecting their respective growth trajectories and investment strategies. SCHG, with its focus on large-cap growth stocks, saw its value increase to $39,404. On the other hand, QQQM, which tracks the NASDAQ 100 and includes some of the largest and most innovative companies, pushed even higher, reaching an end balance of $46,960. This substantial difference in end balance is not just a number. It speaks volumes about QQQM's superior performance, highlighting its ability to yield a higher final value over the same period. With a more substantial end balance, QQQM takes the lead. But how did they perform annually? Let's find out. Annual growth is a vital metric for any investment. How do SCHG and QQQM stack up? When it comes to compound annual growth rate, or KGR, we see a distinct difference between the two. SCHG has demonstrated an annual growth rate of 15.68%. On the other hand, QQQM has outpaced this, boasting a KGR of 17.85%. This difference might seem modest at first glance, but it's significant in the world of investment. Digging deeper, QQQM's superior annual growth rate means that over time, investments in QQQM would have grown more swiftly than those in SCHG. This accelerated growth can translate into substantial differences in end balances over extended periods. For investors, this suggests that QQQM might be the more dynamic choice, potentially offering greater returns on a year-to-year basis. QQQM shows stronger growth annually, but does it come with increased risk? Let's delve into the volatility next. Higher returns often come with higher risks. Do SCHG and QQQ prove this adage true? Let's delve into the world of volatility and risk assessment, starting with standard deviation. For SCHG, the standard deviation stands at 17.92%. On the other side, QQQM exhibits a slightly higher standard deviation of 18.95%. This metric suggests that QQQM, while offering higher returns, also brings with it a bit more uncertainty. Now, turning our attention to the worst years for these funds, we find a close contest in the realm of downturns. SCHG recorded its worst year with a return of negative 31.80%. QQQM, not far behind, or perhaps ahead in a rather dubious sense, posted a worst year return of negative 32.58%. Both funds show similar downturns in their worst years, with QQQM slightly edgier. Next, let's examine how they perform when adjusted for risk. Risk-adjusted returns can provide deeper insights. How do SCHG and QQQM compare when we adjust for risk? When investing, it's crucial not just to look at returns, but how those returns are achieved relative to the risks taken. This is where the Sharpe ratio comes into play. It measures the performance of an investment compared to a risk-free asset after adjusting for its risk. SCHG holds a Sharpe ratio of 0.82, which is quite respectable. However, QQQM strides ahead slightly with a Sharpe ratio of 0.89. This indicates that for every unit of risk taken, QQQM provides a marginally higher return compared to SCHG. Moving to the Sortino ratio, which focuses solely on the downside risk, the story remains similar. SCHG presents a Sortino ratio of 1.33, reflecting good performance in managing downside risks. Yet, QQQM again leads with a higher Sortino ratio of 1.47. suggesting it handles downturns more efficiently, thus providing better returns in adverse conditions. QQQM not only grows faster, but also rewards its investors better for the risks taken. Let's wrap things up and see what all this means for you. After a thorough comparison, know the difference between SCHG and QQQM, but why would somebody choose QQQM over QQQ? And the answer is simple, is that QQQM has a 0.15% expense ratio, while QQQ has a 0.2% expense ratio. This makes QQQM 25% less expensive for the same amount of volatility and growth potential. And just so you have the information, SCHG's expense ratio is 0.04%. As we've unfolded the layers of data, QQQM consistently edged out SCHG across multiple performance metrics. With an ending balance of $46,960 from an initial $10,000 investment, QQQM not only delivered a higher end balance, but also boasted a higher compound annual growth rate at 17.85% compared to SCHG's 15.68%. In peak years, QQQM surged to a 54.85% return, slightly overshadowing SCHG's 50.11%. However, this superior performance of QQQM comes with its own set of challenges, primarily its higher volatility. With a standard deviation of 18.95%, it's slightly more prone to market fluctuations than SCHG. This indicates a trade-off between higher returns and increased exposure to risk, a crucial consideration for any investor. Reflecting on these insights, it's imperative to align your choice with not only your financial objectives, but also your comfort with risk. If your priority is maximizing returns and you are comfortable with a higher risk profile, QQQM might be the more appealing option. Conversely, if a more stable investment that grows at a steady pace is what you seek, then SCHG could be your go-to. Whether you prefer the steadiness of SCHG or the robust growth of QQQM, always align your investments with your financial goals and risk appetite. Thank you for watching, and don't forget to like and subscribe for more insightful investment analysis.